Is tonight's looming U.S. inflation data going to give us a much-needed sigh of relief, or is it literally about to break the markets back? That's the massive, high-stakes question hanging over all of us right now as we brace for a forecasted 4.2% headline inflation print. Just to put that into perspective, that's the highest level we've seen since April of 2023. Hello, everyone. Welcome back to AI Market News. To really grasp what's at stake tonight, we've got to separate the noise from the signal. Headline CPI includes highly volatile categories like energy, which makes total sense when you consider WTI crude oil has surged roughly 62% year to date. But what we're actually monitoring most closely is core CPI. By stripping out that wild energy and food noise, it reveals the true underlying breadth of inflation. Actually, it's more like it shows us the sticky inflation in everyday essentials like services and shelter. If this core number stays sticky, it leaves the Federal Reserve with almost zero room to maneuver, and that underlying mechanism is what ultimately dictates the next interest rate move for all of us. Based on available data, we're looking at three distinct scenarios for tonight, and we absolutely need to be prepared for each one. First up, if the numbers come in line, say 4.2% headline and 0.3% core, markets are probably going to read this as priced in, triggering a nice broad relief rally. But scenario two, if the print comes in hot, meaning headline is above 4.4% or core hits 0.4% or higher, 10-year Treasury yields will likely spike right up toward 4.7%. The mechanism here is that higher bond yields make borrowing way more expensive, which severely discounts the future earnings of growth companies, leading to a massive tech valuation reset. Finally, if the data is surprisingly cool, falling below 3.9%, rate hike fears will just fade away. In that case, tech would rebound rapidly, and we could see gold climb right back toward that 4,400 level. And honestly, the tension leading up to this event is already so visible. As you can see in the chart on the left, downward volatility has really hit the NASDAQ hard, while the Dow Jones on the right is showing a lot more resilience. Just earlier this week, the broader S&P 500 fell 0.26%. But get this, defensive sectors like real estate actually gained over 2%. The why behind this rotation is pretty straightforward. Investors are yanking capital out of high-growth tech and moving it straight into rate-insensitive defensive stocks. It's a classic pre-CPI hedge to protect portfolios just in case that cheap money suddenly stops flowing. But this anxiety isn't just isolated to Wall Street. Notice how the graph shows the Nikkei 225 consolidating, basically hesitating right around the 64,179 level. For Japanese investors, the domestic equity market is incredibly sensitive to U.S. tech volatility and global interest rate expectations. Because Japanese tech heavyweights and major exporters heavily track the sentiment and capital flows of their U.S. peers, any market shockwave generated by tonight's U.S. CPI is going to immediately ripple straight through Japanese equities. Currency markets are equally on edge right now. As you can see in the chart's steady upward climb, the USD/JPY pair has been pushing right past that 160.38 mark, supported by a really resilient dollar index. The underlying mechanism driving this upward pressure, it's the interest rate differential. A hot US CPI print means US interest rates are going to stay higher for a longer period. This dynamically widens the yield gap between high-yielding U.S. assets and lower-yielding Japanese assets, which relentlessly draws global capital straight into the dollar and persistently weakens the yen. Okay, alongside all this macroeconomic data, we also have some massive corporate earnings dropping tonight. Oracle is set to report its Q4 earnings after the bell, and Wall Street is expecting an EPS of $1.96. But the absolutely critical metric we'll all be watching is their Oracle Cloud Infrastructure, or OCI revenue. Strong OCI numbers are essentially definitive proof of sustained structural demand for AI. If they deliver accelerating growth there, this microeconomic strength can directly counteract those big macroeconomic fears we just talked about, helping to stabilize broader tech portfolios. And well, if inflation and tech earnings weren't already enough to digest, get ready for this. We're also looking at a truly staggering $1.77 trillion valuation for the upcoming SpaceX IPO, targeting a $75 billion raise under the ticker SPCX. Dropping literally the largest initial public offering in stock market history right into a week already defined by CPI uncertainty is a severe stress test for market liquidity. Think about the mechanics. To buy into this historic IPO, institutional investors are likely going to have to quickly sell off their existing tech positions just to raise cash. This dynamic could systematically drain capital right out of the broader market, compounding all the stress and amplifying any downward volatility we might see. Looking over at the economic calendar, everything basically hinges on the 8:30 a.m. Eastern Time data release tonight, which, by the way, corresponds to 9:30 p.m. JST. According to current market information, the market is bracing for the exact forecasts you see here. Because this is a massive binary event carrying huge asymmetric risk, the absolute most prudent move for all of us right now is simply to wait. Taking heavy positions before these numbers are officially released is effectively just gambling against unpredictable, lightning-fast bond yield reactions. So the big question remains, will tonight's data provide a much-needed window for the market to brief, or will it trigger the next massive valuation reset across global equities and currencies? We'll find out exactly what those numbers say at 8:30 a.m. ET. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.